on the topic derivatives. I, C. Ashish Gupta, Deputy Director Board of Studies, shall mentor the session. Students are requested to go through the disclaimer statement. And please also note down the important points. In this regard, it is requested to note, please note, there is no change in the syllabus at all, because unlike other papers like income tax, corporate law, etc., SFM does not incorporate such changes. So please don't worry, there is no change in the syllabus. It is a standard statement, and you can go to the student learning management system through our ICI Cloud Campus. These are free of cost. Just you need to register with your student registration number and start learning immediately. As I told you earlier, today we shall discuss the topic of derivatives. Students are requested to ask their queries relating to this topic during the session. Please don't wait. The session will be over, only then you will ask a query. You can in between ask your query. We will answer the same. Now, first of all, I am taking some of the queries that we have received through email. Practice manual question. This query is not clear, so it is need. So it is not clear, so we cannot take the same. Next query is what is derivative? That I am covering in a greater detail. So don't worry. Our session will start with the introduction, and you can say complete coverage of the topic of derivatives. Now there is another query, manner of presentation of answer for the good marks. Friends, whether the question relates to the derivative or any other topic, please note, there should you have a logical flow of an answer, plus adequate working notes, and plus conclusion if you have been asked. So for this purpose, I recommend the students that you should see the presentation that is provided in our practice manual. Sometimes it is a doubt in the mind of the students, sir, whether we need to show each and every calculation. In my opinion, you need to show each and every calculation. Only just you have to show the broad calculation, that how you have arrived at a particular figure. So keep practicing question answers from practice manual, and even you can also refer the mock test for better presentation also. Now, how to address the derivative problem? Friends, whether it is a derivative problem or this problem or question relates to any other topic, you should have a conceptual clarity. It is a very important. It is utmost important. You should have a conceptual clarity of the topic. Next, read thoroughly problem, because it has been seen that students normally read the problem in hurry and sometimes ignores the important points. So it is important that they should read the question thoroughly. Need to know more about derivatives, that we will cover in our 3 mentoring session, 2 days, and another 2 sessions also, that is tomorrow and day after tomorrow also. Derivatives is hard to understand. Friends, if you are watching this session, then after going through these 3 sessions, the derivative topic will become the most easiest topic for you. That I am making sure. Now, which practice manual addition is applicable for May 2000 examination? Friends, first of all, as I told you in the beginning, so far as the paper of SFM concerned, there is no concept of applicability of any particular edition of practice manual for any particular examination. However, it is always better if you take the latest edition because it covers latest questions, latest suggested answers questions also are there, and in fact, it also incorporates the minor corrections of errors or mistakes that has been came to our notice during the year. However, this time you for this exam, I will say you can refer the January 2015 edition. In addition to that, we are coming out with the one supplementary that will supplement this edition. You can also refer the same. Now, let us go to the topic of derivative. Before we go to the basics, let us see whether we have received any question or not. I think we have not received any questions. We are going back to our session. Friends, now question rises, what is derivative? Please note down, derivatives are the contract that derive their values from the value of some underlying instrument or index. So it is important to note underlying, first of all, underlying instrument or index. This instrument can be anything. Say it can be shares, it can be commodity, it can be forex, or it can be interest rate, or it can be anything. Underlying can be normally these are related to some financial more financial instruments. However, commodity is also a part of the derivative. Now, if we go by plain definition of derivatives, the broad categories in which the derivatives can be divided are forward contract, future contract, options, and swaps. Now, these four topics we shall discuss in greater detail. First of all, as I told you earlier, these are our four underlines. Index is also there. We can say we can incorporate here also. Index is there. Now, and under this category, if we further divide, categorize these four underlines, then we can say like that: forward, future, options, and swaps. Normally, swaps are applicable for equity. So normally for commodity, and if one is forex. So for these two, the swap can be there. For index and commodity, normally there are there may be some contracts, but they are quite complicated contracts. Now, so far as the interest rate is concerned, in this category, there are forward contract, there are future. This is called interest rate future, and this is called interest rate option. Now, student, please don't worry. I will discuss in greater detail every term forward, future, and option. It is just only for your noting and reference. So I am coming back to previous slide. Here, derivative can also be classified like on the basis of, there you can say execution mode, that is forward, future, option, and swap. And classification of derivative on the basis of underlying is like that. And concludingly, we can say that ultimately we have to see what are our forward. Say forward can be for the shares, forward can be for the commodity, forward can be for the forex, and forward can be for the index, and forward can be for the interest rate future. So for these all things, forward contract can be possible. So regarding derivative, if we say derivative, what are their uses? They can either be used for arbitrage, they can either be used for speculation, or they can be used for hedging the risk. Now, what is arbitrage? I think it must be very clear to the student. However, I am just repeating here again. Arbitrage is nothing. It is buying and selling something. It can be your forex or it can be anything. Buying and selling something simultaneously without making much investment. For example, a person purchase the share from DSC, that is Delhi Stock Exchange, and sell immediately at BSC. It may be possible that he may purchase the share for rupee 100 and he may sell the share at BSC 100 rupee 50 paisa. In that case, the arbitrage gain will be of net of rupees 0.50, that is 50 paisa. Now this arbitrage gain, we can see the amount of investment by this person is very less. So far as the speculation is concerned, in case of a speculation, a person buys something or sells something in hope of rise or fall of fall of prices respectively. In case of a speculation, he has to make investment. So there is basically the, if we see a, the difference between the speculation and arbitrage, the difference is of on account of investment of the sum. In case of arbitrage, there is no investment. However, in case of speculation, there is an investment. It may be possible when a person buys some share, or we can say something in hope of say in the rise in the price. Say Mr. X buys a particular quantity of wheat at rupees 20 per kg because he is anticipating that the price will rise. Suppose after 3 months the price comes to rupees 22. In that case, he is making a speculation gain of rupees 2. So it may also be possible that the price may come down to 18. So in that case, there will be a loss. So both possibilities are there. But however, whatever he is doing, he is basically bullish about the price rise. That's why he is buying. Or it may also be possible that he may think reverse. That how he can think reverse? He is expecting today the price is 20 and it is likely that the price is coming down to 18. In that case, what he does, he sell in advance. Okay, when the say he promise with someone that after 3 months I will sell you at a rupees 18 at rupees 20, and say after 3 months the price comes to 18 rupees. In that case, what he will do, he will directly purchase wheat at the rate of rupees 18 per kg and will sell to this person and will earn the rupees 2. So by this, he makes a speculation gain of rupees 2. Now last purpose of, or we can say it is a prime purpose of hedging. What is hedging, friends? Hedging means coverage of risk. This risk can be of any type. Say this risk can be of a forex, This risk can be of a fall in share prices. This risk can be of interest rate risk. This risk can be, say, if we are a borrower, then we have a risk of that the in a future time when we are going to borrow, it is likely that the rate of interest is are going up. So this is a risk. Similarly, if we are holding a portfolio, there is a risk that the value of portfolio, say today we are holding a portfolio 1 lakh. If market goes down, so it is likely that our portfolio may value may come down to rupees 90,000. So in that case, we are carrying a risk. Similarly, in case of a forex, the forex topic we will cover separately. However, for reference, if I am giving you just hint here, suppose if you are you are an exporter, and you have exported a goods to the tune of dollar 1 lakh. Today, say dollar's rate is 68. Now you are anticipating that by the time the proceed of export will come after, say after 3 months, the rupee is likely to be stronger, and the value of dollar is likely to be 67. In that case, there will be a straightforward loss of rupees 1 per dollar, and for 1 lakh dollar, the total rupees loss will be 1 lakh. To overcome this risk, you can go for the derivatives contract that we will see in the topic when we will cover the forex. So from this we can see there are the various type of risk, and to overcome this risk, or you can say we cover to this, we take the uh, use the derivative products. Now let us come to first derivative product, that is forward contract. Now I am writing down the definition, and we will understand each and every term one by one. Forward contract, or simply forward contract, is simply a non-standardized contract between two parties to buy or to sell an underlying at a future time at a price agreed upon today. Now here if we see the plain definition, is non-standardized. You know, underline the points. In non-standardized between two parties, that is a plain definition of a contract, because whenever we see the definition of a contract, it is basically an agreement between two persons competent to enter into an agreement, or enter into a contract to do something lawful, or you can say for lawful object, for lawful consideration. So this is the basic definition of a contract. Now, in this contract, when we enter, there is a non-standardized contract, and to buy or sell an underlying. This underlying, as I told you, it can be forex, it can be index, it can be commodity, it can be interest rate, now here another important point to note, future time. So please note, in a forward contract, the delivery shall not be made, or the execution shall not be made today. that is on the date of contract, rather it will be made at some future point of time. And another important point, at price agreed upon today. So from the plain definition of a forward contract, we can say it is a kind of a contract that we agreed upon today at some price to do something at some future point of time. Now see, let us see how the future contract is used. Friends, say I take a very simple example. Say there are two friends, one is X, another is Y. Now here X is a bakery owner and Y is a wheat producer, that is you can say it is a he is a farmer. Now say when there's a he's a bakery owner, he produces the breads. Now in that case what happens, when he is producing the bread and bread is produced from the wheat, so his worry is the wheat or particular quality of wheat that he is using is rupees 20. He's worried that the price is likely to be go for rupees 21. In that case what he does, he is expecting that price is going to be 21, so he's worried about the same. Now on the other hand, his friend Mr. Y is a wheat producer and he is producing the same quantity of wheat, same quality of wheat. Now in that case his worry is that the price is likely to be 18. Now his sentiments is bullish regarding the price and his sentiments are bearish about the price of the particular wheat. Now say they come together and decide. How they decide? It is decided that Mr. X will purchase, say, whatever with the wheat produced by Mr. Y, or say we can say 1000 ton of that particular wheat, and Y will sell at rupees 20 the same wheat to Mr. X. So this agreement is likely to be executed after say 3 months when the crops will be ready. Say that today there is a time of January, or you can say it's the end of December, and the crops will be ready by the end of March, or you can say mid of the April. Now in that case both parties are sure that here the X is not worried about the price rise and here Y is not worried about the fall of prices of wheat. So by this the risk of both the parties have been hedged. Now we have seen a very simple example. Now next question rises, what is the price of forward contract? Now what is the price of a forward contract? Here when we determine the price, or you can say it is also called the valuation of forward contract. Please note, whatever the methods we shall discuss, the same methods will be applied to the future contract. I will discuss the future contract later on because there are some differences between forward and future contract, but the modus operandi of valuation of both the contracts are same. So please note, whatever we are discussing for valuation of forward contract, the same concept shall be applied for the future contracts also. Now when we value the forward contract, there is the relationship is carried out by, you can say it is determined by the cost of carrying. What is cost of carrying? Let us see. Cost of carrying is nothing but you can say future price or forward price equal to spot price, that is price today, plus carrying cost minus return or dividend. Now what is carrying cost? Say if I say the one share worth rupees 100 today and I want to purchase the same after say 6 months, and the current presently the rate of interest is 10%. In that case, a person may be ready to enter with me to sell me the this particular share after 6 months at which price. So he will ready to sell me at a price of say 105. How this price has been determined? He says today I am investing a sum of rupees 100 so that I could sell you or deliver you the share after 6 months, and today I will borrow the rupees 100 from the market so that I could purchase one share, and rate of interest going in the market is 10%. So accordingly 10% per annum. Accordingly, the rate of interest will be 5%. So by this, he will sell me this will be the future price. Now, suppose if it is expected that between say after 3 months, the company will give a dividend of rupee 1. In that case, we shall reduce the benefit from this future price. So the value will be 104. Here, one important point need to be noted. The difference between the spot price and future price is called basis. That is spot price minus forward price. And it is very important to note, it is in a normal market, the basis shall always be negative. Now, if it is not negative, then we call it inverted market. If we go by the diagrammatic presentation, this is future price. As per normal market condition, this is a time period. With the passage of time, say today we are here and this is our future price, this is our spot price, and this is our future price. So as the time passes, both prices start converging with each other, and at one point of time when this contract is likely to mature, the basis becomes 0. Now this called convergence. This diagram is called convergence. In that case, we have to see in a normal market condition, it is said that future forward price or future price will always be greater than spot price. So this is called contango. And if it is reverse, say if we say forward prices are less than spot prices, it is called backwardation or invert market. Because it is rarely found that the forward price are less than spot prices, because forward prices always carry some carrying cost. If it is there that forward prices are less than spot prices, this may be due to some factors other than market. Otherwise, in a pure market conditions, our forward price will always be more than our spot prices. So I hope with this, the concept of spot price, forward price and spot price must be clear to the students. Let us go to back to the question answer session. Please use white color ink. Okay, we will go for the same. How are we supposed to prepare for theory question? What is the weightage of theory? Friends, you can prepare the theory questions from the practice manual. It is best because there are short notes are given in the form of questions in the beginning. You can prepare from there. In addition to that, I will also advise if you refer the study module, our ICI study module also, that will be a best, because when you start going through the module after going through the practice manual, you will came to know there are some more concepts are there, and you can also get their knowledge from there. For some problem in practice manual, answer are derived in more than one method. Whether we need to write all the method? No. Only one method you have to do. It is a you need to jot down your all the method, because alternative methods are there only just to guide you. You not to jot down your all the methods in the examination condition, because that will it will unnecessarily waste your time. Are you said refer practice manual solution answer of some questions are either wrong or way of computing is very complicated. Yes, presentation of some is very good. Some is not clear. What exactly wants to say? Not getting derivative concept. What friend? I think this from the Pavan. Pavan, I have just started the derivative concept. When I will start taking questions, then it will be clear to you. As I told you in the beginning, derivatives concept is not very easy to understand, but just you keep have a patience, or otherwise you can give me the call, a telephonic call at the number I will provide in the end of my show. Explain the concept of value of hedging for increasing and decreasing the beta of that I will discuss, because I have taken this two questions in my today's PPT. Don't worry, I'm covering this question. For some question, different answers through different methods are given in pencil as compared to the compiler. What is to be done in such cases? While such questions in exam not specific to general question. Friends, I think if there are some differences are there, then it will be better if you bring these differences to our knowledge. We will give you sessions according, because we cannot give you any general guidelines for the same. It will be better if you contact us personally through email or through over the telephone. We will guide you on this matter specifically. Please provide practical insight about arbitrage so we can apply to the problem. So, student, I am just discussing from practical point of view. However, I will not advise you to go to the market and practice in from the site. You don't start. I will say don't start practice at your own, or you can say you will start attached with some broking firm and then start doing the arbitrage, because it's a risky process. I will advise you first you concentrate on your study point from you are concentrate on the concept from study point of view, examination point of view. Then only you can try it in the market. However, what I am speaking, what I am telling you about arbitrage, that is practically used, and we can also use them in a forex, and we can use also them in interest also. So that I will cover in my next sessions. Now let us go to our how to proceed in the arbitrage question. I am just taking one by one questions that you will come to know. Now let us go back to the slide. Now friends, let us take some questions. I will advise every student to refer the practice manual edition of 2015, January 2015 edition. I have taken this problem from the chapter number 5 and question number 38. Student, please read the question carefully. Take your time, 2 or 3 minutes. Students, those students who are having a old edition, these questions must be there also, except 1 or 2 questions. I think all questions must be there. In this question, the question is like that. The following data relates to Anand Limited share price. Current price of per share is rupees 1800. 6 month future prices of the share is per share rupees 1950. Assuming it is possible to borrow money in the market for transaction in securities at 12% per annum, you are required to calculate the theoretical minimum price of a 6 month forward purchase and explain arbitrage opportunity. Now let us see how we how we go in the forward. Friend, as I told you earlier, now today's price is rupees 1800. Now say if I invest today 1800, so what I am doing, I am foregoing the interest for the 6 month, and the market rate of interest is 12%, and the period is 6 months for 12%. So accordingly, it comes 1800 plus 108. So here 108 is the amount of interest. Friends, I will say, if you are very clear about the concept of time value of money, then the concept of forward valuation will be very clear to you, because it will not pose any problem, because there, as we told you earlier, from in time value of money, normally we come from future to present. Here we are going from present to the future. So here we are on a present, and here we are going to the future. So this is our interest sum. So accordingly, the forward price justified is 1908, because if today I am investing 1800, and accordingly if I am losing interest, the interest amount is 108, so the price should be 1908. Now it says whether there is an arbitrage opportunity. Yes, there are there is arbitrage opportunity. How it is there is an arbitrage opportunity? Say if today I borrow rupees 1800 at 12%, then how much I pay? Because I am not investing my money, I am just borrowing the money and buying the share in a market at 1800. So my cash flow will be nil. I am borrowing 1800 and buying the share from this. Only thing I am doing, I am paying 108 as an interest after 3 months. Now from where I will get this interest? After 3 months, you can say I have to repay the amount of 1908. However, if I sell the share, I sell in a spot at future price of 1950. What I do, I am selling this share today, but at some future point of time, that is say after 6 months, and a future price of rupees 1950, and I am repaying the loan along with interest. This is coming 1908. So the balance amount of rupees 42 will be my net profit, and this will be my arbitrage gain. So I hope how we have to approach, or how we have to proceed in the arbitrage question is clear to the student. Here, student, it is very important to note, although it appears arbitrage appears to be very easy game, but please remember, arbitrage normally appears for a fraction of second, especially in a context of the foreign market. It normally appears for a 2 or 3 seconds. Next, I am taking the question number 36 of practice manual 2015 of chapter number 5. Students are requested to go through the questions. It is a very small question. Here it is saying the 6-month forward price of a security is 208.18. The borrowing rate is 8% per annum payable with monthly rest. What should be the spot price? Friends, here we shall discuss the concept of compounding that you must have discussed at your IPCC level. Now here when it says monthly rest, it means we will use this formula. Now how we arrive this formula? Say initially the formula is like that, 1 plus r raised to power t. Suppose if I say the rate of interest is 12%, then what will be the amount after 1 year? According to this formula, if today I invest rupees 100, then raised to power 1, the amount will come 112. Now, if I say my interest is compounded quarterly, in that case, what I do, I will divide this 12% by 4 and multiply by the, and t will be multiplied by the 4. Accordingly, the figure will be like that, 100 plus 0.03, sorry, it is not 4, raised to power 4. And accordingly, the sum would be 112.55. So friend, we can see there is a more interest, there is a difference of interest by 0.55. This is on account of multiple compounding. That is, we are compounding within a period more than here. Here in this question, it is saying the price, forward price is 208.18. Now we have to know what is spot price today. And our interest rate is 8% per annum, and the interest rests monthly. It means the interest is compounded monthly. Accordingly, what we do, we put these values in the formula. P is, say, spot price, and our rate of interest is 8%. Here, since our compounding is 1 month, that is 12 times in a year, 1 raised to power 6, because here what we are doing, we are want to compute the, or you can say, we can write like that, our period is half year, and we can do like that also. So our value will be 208 p into 1 plus 0.0 0.0625 raised to power 6, because we have divided here 0.08 by 12. Sorry, it is a 6667. So when we compute this value, the value will be 200. So our spot price will be 200. We can also determine this. We can also cross verify this amount also by multiplying 200 plus 0.08 divided by 12 half into 12. That is the amount will become around 20. So by this we can also verify the answer. So I hope with these two examples, the valuation of simple forward price must be clear to the student. Now let us go back to the question answer session. Are questions on forward as important as one in the future option, considering that majority problems we have taught in the future and options? See, I cannot say that the forward is more important or less important. You should have a thorough understanding of your all the concepts. Explain hazing by using, as I told you earlier, beta, I am just coming to the same. Please have patience. Which edition of practice manual I have discussed earlier? 6 months or 3 months? It is not clear which you are referring for 3 months and 6 months. 1 minute. Let me go back to the slide. I want to say, I think, 3 things. Here, beta, we are using 6 months because he is saying 6 months forward price of a security is like that. So here we are doing half year into 12 months, and accordingly the value will be 6 of 6 months. I hope the concept will be clear to you. Now I am coming to, before going to another example, I am discussing one important thing with you, that is continuously compounding. As we have in a previous slide, we have seen when our interest is compounding more time, we are multiplying n with the t, and according to this, like in case of a quarterly compounding, we are dividing by 4 and multiplying with the 4. In case of a half yearly compounding, we are dividing it by 2 and multiplying with the 2. In case of a 1 month compounding, we are dividing it by 12 and multiplying with 12, that is time period. What happens when we say we say compound the interest on daily basis? In that case, when we compound the interest on daily basis, in that case we use the concept of epsilon, that is E value, and value of E is 2.178 approximately. Now say, if I say the rate of compounding is 10%, then what will be the proceed of 100 after 1 year? Here we will compute the value like 1 year, say 1 year. If we say it is a 2 year, then we shall compute the value by the value of E or epsilon are normally available in the questions, or they may be available in the tables provided to the student in examination. From there we shall find the value of E raised to power 0.10 and we will multiply the same. So continuously compounding concept must be clear to the student, as normally In a case of a derivatives, the concept of continuously compounding are frequently used. For this, we let us discuss one question this question I have taken from your study module. The edition is 2015. Student can take the time just to go through the question. Now question is like that. Consider a 3-month maturity forward contract on a non-dividend paying stock. Please note, it is a non-dividend paying stock. The stock is available for rupees 200, that is a spot price, with continuously compounded risk-free rate of interest CCRRI of 10%. What will be the price of the forward contract? Here, as I told you, price will be computed like that: 200 into epsilon. Now here we have to find the price after 3 months. So our year will be 1/4, and rate of interest is our 10%. It is like that. So our forward value or price of forward contract will be 205.06. If we try it by our simple formula, say of compounding, the value like that, or we can say 200 into 1 plus 0.04, this. Our value will be 205. So here our, we can say, our benefit of additional of 0.06 is on account of continuously compounding. Let us go back to the question answer session, whether we have received any question or not. In the question, the time is 6 months, but you said this might have been, I haven't said 3 months, but if the question is of 6, it may be an error of whatever. Now concept of margin I will discuss. Derivation of formula of probability in Q. Question number 42 of lectures manual. This probability that I think that is related to your valuation, or you can say delta hedge, that I will cover in tomorrow or maybe day after tomorrow slide. Now here we have discussed the question, that is, it was a non-dividend paying stock. Let us discuss a question where there is some amount of dividend is there. This question is again from the study module, page number 5.33, chapter number 5, edition is 2015. Students are requested to go through the question quickly. Now, when in this question there is some cash income is accruing, and what is our cash income? Our dividend is of 2 rupees 50 paisa per share. In this type of questions, The formula applied is spot price e raised to power nr. Accordingly, if we use the same formula here, we can compute our price of share is 500. Okay, and sorry, our 500 shares are there, and our price is 75, or dividend of rupees 2.50 is per share, and it is the rate of interest is 10%, and we have to compute the value of 3 months contract. Accordingly, the dividend proceed we have received, the cash flow we have received is 2 rupee 50 paisa into 500. The amount comes 1250. Now here this dividend is accruing after 3 months. So what we do, we compute the value of dividend. The say this formula will be applicable only if the dividend has been declared after 4 months. Now here, since dividend has been declared after 3 months and we have to compute the value after 4 months, so first what we do, we compute the present value of dividend that is likely to be received after 3 months. Now 1250 is our likely inflow, our time duration is 3 months, and rate of our dividend is 10%. Accordingly, this value comes 1219.13. Now we shall compute the value of forward contract. Now spot price is 5,500 into 75, and the present value of dividend is 1219. Accordingly, our investment compounding by 4 months and the rate of interest is 10%. So value will be 36280.87 into e raised to power 0.033. Now value comes 37498.11. So this will be the value. Here we have reduced from our present value of cash inflow, present value of cash outflow, the present value of cash inflow on account of a dividend. So because it is a dividend providing stock. Now before we proceed to another question, it may be possible that we may be provided in the question the dividend yield. Cost and y will be our yield of dividend. In this context, let us try one illustration or an example. This illustration is from the study module again at page number 5.33. Students are requested to go through it quickly. Now in this question, the current value of index. Now here, before I proceed further, I will likely to discuss the concept of index. Let us see what is the concept of index. Index, it can be said, it is a kind of a barometer of the prices of shares like Nifty, Sensex. These are all the indices. Now, in this case, what we do, we normally analyze whether the market is going up or whether market is falling. Judge from the index. Now, he says here index has been mentioned. Students, we also trade in the indices, because since indices are only a barometer, they does not have any physical existence like shares, etc. So normally their trading is only on a cash basis, that I will discuss in further detail when I will take up the topic of future. So only here, for your sake of clarity, I am just saying we can also deal in the index, and accordingly we see the how these questions can be solved. Now consider the stock current value of index is 1400, dividend yield is 6%, and continuously compounding risk free rate of interest is 10%. So what we want, what how we can find the value of the 3-month forward contract? Again, we have discussed in the formula. Our CCRI is 10% and our yield is this, and our time is 3 months. Now the value will come 1414 approximately. So this will be the value, forward value, or we can say future value of the index. Now let us go to the question answer section. You cannot see the slide of expansion. Please check. Okay. Please check the slide. Okay, now let us try some more questions. Before we go further, let us discuss the concept of the future contract. Friends, there are broadly some glaring differences between the forward contract and future contract. What are these differences? First, in OTC in nature, that is, and these are on organized exchanges. Normally forward contracts are, say, between two persons or between two parties, and normally over the counter means when they sit at any place. This is not necessary that they should be at a counter, on a physical counter. Either it can be on a telephone or it can be through a email, whatever with the mode. But in this case, they normally meet informally, although for some formal agreement. But here they are on the through the organized. Like earlier we have discussed the example of X and Y. Now in a forward contract, they are meeting with each other. They can either be sit together, or they can either do in a over telephone or over the email exchange, whatever with the mode, but they are doing among themselves. Now in between this, if we introduce the exchange, then it becomes a future contract. So accordingly, forward plus exchange mechanism becomes the future contract. Now in case of a future, everything will be through the organized exchange. So in that case, the first X will have to punch his order in exchange of buying the wheat. On the other hand, Y will punch his order to sell the wheat in the exchange, and this exchange that will carry out the transactions. So one of the very glaring difference is OTC market is a over the counter, or is a mutual agreement, or you can say It is a kind of informal or it is a on an organized exchange. Now, another important is tailor made or customized. It is standardized. Say again, taking the example of X and Y, it may possible the X may be entering into the agreement, say of purchasing 1,110.25 ton of wheat. Because this is an agreement, this is an agreement or this is a contract between X and Y, and there can be reached at any quantity. However, in case of future, there must be some standardization of contract. Say you can take only one contract is equal to say 2 ton. In that case, when his requirement is 110.25, either he can take 505 contract or 506 contract. The contract cannot be broken. So this will be the whole numbers, contract will be in the whole number, because the size of a standardized contract or standardized size of the contract is 2 ton. Another feature is less liquid. It is more liquid. How it is more liquid? Because in case of future market, since the contract is through the future, normally whatever with the position we take, that I will discuss in further detail, further in more detail. If we are a buyer, we can cancel our contract, or we can say if I have a long position, I can cancel my future contract by taking a short position or sale position. Similarly, if I am a seller, that is, I have a short position, I can cancel out my contract by taking a long position. So hence, these future contracts are more liquid. Another glaring feature is no margin required. It is required the margin. Margin means there is some amount of money that which we can initiate the contract. As we have discussed in earlier, there in our contract X and Y, although they are agreeing to for buying and selling of wheat at rupees 20 per kg, still they are not paying even a single penny to each other. Whereas in case of future contract, both will have to pay some margin amount to the exchange for taking the contract, that is X. For X it is buying a contract, is buying, and for Y it is a selling. So for both of them have to pay some amount of margin money, and this margin money normally vary from 5 to 10%, or it can be otherwise, but it normally of the value of contract. Now another more important feature is no daily settlement, and it is basically based on the marking to market. That is called daily settlement. Daily settlement. In this case, what happens in a future contract? The buyer or seller both are normally at the end of each day, their contract is cancelled and a fresh contract is entered. The concept of marking to market I will discuss when I will take one problem on this, because it's a very one of the very important concept, and that is the in my opinion is a very one of the major feature of a future contract that distinguishes it from the forward contract. Another important feature is counterparty risk. In a forward contract, there is always a counterparty risk lies, whereas in future contract there is no counterparty risk, because in our earlier example, in case of our X and Y example, if any of the party defaults, then there is no remedy with the other party except going to the court. However, in case of a no future contract, there is no counterparty risk, because if either of the party defaults, it is a duty of the exchange to fulfill the commitment on the behalf of other party. So the counterparty risk becomes zero. and this is the one of the more important feature also that makes the future contract more favorite in comparison of the future forward contract. Now let us take one problem on a future contract. Is a very simple problem. I have taken it from the practice manual, question number 33 of the chapter number 5. Please read out the question carefully. Here it is saying the share of X Limited is currently selling at rupees 300 and risk-free rate of interest is 8.8% per month. A 3-month future contract is selling for rupees 312. Develop an arbitrage strategy and show what will be your risk-less profit for the 3 months, hence assuming that X Limited will not pay any dividend in the next 3 months. So friends, here I'm although student can refer it from their study material from their practice manual. I'm just briefing them in a very simple manner. Now today, since our spot price is 300 and risk-free rate of interest is 0.8%, so we can determine an approximation of our future price. It is 300 into 307.26. Now since it is selling at 312, so there is an arbitrage opportunity. And what is arbitrage opportunity? We can sell in advance at future price and we can earn a riskless profit of 4.74. So I hope with this the concept of future must be clear to the student. Now let us go back to other problem. This is question number 39 from the practice manual. Calculate the price of 3 months PQR future. If PQR, here it is share. Please note it is share. It is not future. Face value is rupees 10 and quotation is rupees 220 on NSE. And the 3 month future price quotation is 230. So here, friends, it is very important to distinguish between the cash price and future price. The price of the share is 230 and the 3 month quotation of the future price is 230 and a 1 month borrowing rate is 15% and the expected annual dividend yield is 25% per annum payable before expiry. Examine the so first we have to find out the first we see how we can determine the future price. As future prices are also determined on the basis of cash prices of shares. Our spot price of the share is 220. I am investing this much of amount today. Rate of interest is 15% per annum, and for 3 months we are multiplying with 0.25 into 220. This much of interest I will pay, and out of this I will get a dividend of 25%. However, my dividend will be on the face value. So my dividend will be this much, and the future price comes 2.225.75. Since our our future is quoting at 230, we have our arbitrage opportunity. What we do, we sell the share in a future market at the price of 230, and we have a gain of 230 minus 225.75, that is 4.25. So with this we can have an arbitrage gain. Now let us go back to the question answer session. Why is the standard deviation is tripled in addition to the sir? I will take this question, don't worry. Although what I am discussing you now, it is a formula for determining the initial margin. So this is a, you can say it is already, it is normally established formula. You cannot have any say on this. Please repeat the concept of tailor-made. I just repeat you the same. Sir, can't we see the slide? We can't slide this. I think only the you must have been facing the problem because the slides are clear to other students. We have confirmed it. Please repeat the concept of tailor-made. I am just discussing that concept of tailor-made. Now, student, the concept of tailor-made, I will say very simple example. Say, if I go to a shop and I want to buy a shirt, so as per my physique, the shopkeeper maybe say, sir, you buy the shirt of say for 40 or 42, depending on the brand. Because I have a no choice, only just I can purchase the shirt as per the standardized, or I can say as per the standard size available in the shop. On the other hand, if I purchase the fabric of my shirt and go to a tailor and give my measurement of my body, and the shirt that will the tailor will stitch for me, that will be called tailor made. So this shirt that will be as per my physique, and I think this shirt cannot be fit for any other one because the shirt has been stitched according to my body size, and it may possible my friend or my brother cannot put on the same shirt because, and it will be uncomfortable for them because our physique may be different. So I hope with in a similar manner, when we come the forward or future contract context, if I am interested in say buying currency of say 1225 only, whereas the standard size of the currency is contract in the future market is $1,000. So in this case, for the remaining $25, I will take the another portion that we will discuss when we'll see the for future foreign exchange. But I am just for the sake of example, I am just saying. So here my requirement is $1,025, but the standard size available in the future market is 1,000. So in that case, for $25, I have to arrange something else. So, but only I can take the one contract. If I enter into with a bank, I can enter into with this tailor-made contract. But if I go to the NSE to hedge my position, then I will have to take only one contract. Now let us take one of the question. Before I take this question, I give you one student has asked how we can use the index future to hedge our position, or we can say hedge our portfolio. Friends, as I told you earlier, index future is nothing but these are the indicators, or these are the barometers. I will give you a very simple example. Before I give you an example, I will discuss one important concept of beta with you. Now, what is beta? That is normally the concept we covered in a portfolio management. However, for the sake of say our discussion, I am just giving a very brief introduction, or we can brief review of the same. Now, beta is nothing but beta is a volatility of a particular security vis-a-vis to the market. Say if I say my beta the security of a particular security is 2, it means if the market rises by 10%, this share will rise by the 20%. Accordingly, if I say the market falls by 5%, this share will fall by 10%. So accordingly, the beta is the indicator of although it is an indicator of risk, but it is this risk is context of a market, and as you can say, it is a indicator of a market risk. So accordingly, if the beta is less than 1, so our impact on the prices of share will be less than the impact less than the market. Now, when we use the index future for our hedging, beta is very important for us because accordingly we will adjust our position. Now see, let us how we use the index future. Suppose if I am holding a contract, I am holding a portfolio. We are, I think portfolio must be clear to the all students, but for the sake of just their knowledge, I am just repeating again here. Portfolio is nothing but it is a combination of some shares or assets. If say I am holding the portfolio or combination of some shares whose values is 1000 today. Now I must have some beta, or you can this portfolio must have some beta value, say it is 2. Now in that case, if market falls by 10%, the value of my share this portfolio will fall by 200 because my beta is 2. It is computed like that, 10% fall and it is 2, this will become 200. So my the fall in the value of in the portfolio will be 200. Now here when the value of portfolio my portfolio will fall by 200, what I will do to cover up my risk, I will enter into an opposite position. If I am holding a portfolio, what will I do? I will take a short position in the index future because index future is determined by the index. Whatever be the loss I will incur on my portfolio, that will be covered by my position in the future market. Because if in a market, if index is trading at say 100, and if I am short position means I am selling one index as rupees 100, and if later on it comes rupees 90, I am selling here, I am buying here because I have to close or offset my position. There will be a profit of 10. So by this profit, I will adjust my loss. To understand this, let us discuss one question. Before that, we take a question. Let us take one question more. I will then I come to back to it. This is question number 34. This is question number 34. This question will be the best example to explain the hedging from the index portfolio. I am reading out here question. A mutual fund is holding the following assets in a rupees crore. The investment in diversified equity share is 90. The cash and bank balance is 10. The beta of the portfolio is 1.1. The index future is selling at 4300 level. You can say it is a kind of a nifty, or you can say whatever it says. The fund manager apprehends that the index will fall at most by 10%. Now it is his appreciation. It is his apprehension that the index will fall by 10%. How many index futures should he short? As I told you, we will take a short position to for the perfect hedging. One index future consists of 50 units. Substantially, your answer assuming that will materialize. Now here, let us solve the question. Now, as I told you, our beta in the question is given beta 1.1, and our portfolio size is 90 crore. So accordingly, our exposure in the market is this much, and the contract size is 4300. Contract size, or contract value, contract size is 50 units. So accordingly, the contract number of contracts we are likely to this 4605. Now by we have short this number of contracts. Now if say I assume that the market falls by 10%, in that case what will be my gain, friends? Now since I have sold the contract at 4300, if market falls by 10%, the new value will be 3870. Now in this I have sold, and in this I bought, so my profit will be 430 per index. And since I have entered into 4605, one contract size is of 50 units, and my gain is 430 units. The resultant gain will be approximately 990,700. It will be around say 9.9 crore. So this will be my gain on account of my index position, that is short index position. And what will be my loss in the portfolio? My loss in the portfolio will be, since I am holding a portfolio of 90 crore and market falls by 10%, so my loss will be, since my beta is 1.1, so my loss will be 11%, and 11% of 90 crore will be 9.90 crore. So whatever be my loss, that will be set of my profit in a short position. So from this example, it is very clear how we can hedge our position. Now let us take our question answer session, then we shall wind up the session. We have not received any questions, so we shall continue our discussion on the derivatives in a tomorrow session from 3 p.m. onwards. Thank you very much. Have a nice evening.